All right, Yield Nerds episode 176, and I have unearthed a trick to match the NASDAQ in returns while also saving on taxes. How about that? I'll tell you how I'm doing it as I play tug of war with this bear in the market, and I'm going to take that big stack of money from that bear. Well, we're up to 480 something. It might even be more than that. I think it's 488 subscribers. Didn't update that. Oops. Well, if you're new to this show, please use the roadmap, and that organizes this show in a chronological manner. I tend to talk about a couple of different subjects in fixed income, preferred stocks. There is a playlist. There is something called Yield Super Bowl if you haven't seen it before. And there's also one on municipal bonds that I've gotten to love over time. And most importantly, remember that I have no magical powers of prediction, so make sure you do your own homework. Well, four parts. We're going to look at the market temperature, and I wanted a really nasty, scary looking bear, except Dolly messed it up and created this cartoon bear, but the market has some bulls and bears going on there. We'll talk about how I'm doing, what my portfolio is doing, how my stock picking strategy is doing, and also some crazy returns in the municipal bond market that I'm kind of hoping for, and I'll show you some proof as well. And finally, my holdings. Hey, my equity portfolio is out from the doldrums, 10.5% in the last quarter. The NASDAQ, of course, has been fabulous at 13.8, but I got a couple of other things going on in my equity portfolio. I have a very nice dividend revenue on top of the stock growth as well. We'll talk more about it, and I'll tell you how I'm doing it. For those of you who have seen my portfolio before, you will know that a very large percentage of my portfolio is indeed fixed income, and equities are a tiny, tiny fraction of my portfolio, but it is still growing, and I keep buying equities as they make sense. My treasuries are now down south of two-thirds, more like 60 something percent, and my municipal bonds keep going up because I like what I see there lately. So let me focus on equities first, and then I'll go to the munis. Specific to equities, I will tell you my picking strategy, but before I tell you my strategy, I want to remind you I am not a wealth management advisor. This is not investment advice. I don't endorse products, I don't do politics, and I don't have any snake oil to sell, no merchandise, no advertisers. So I use two filters to pick my stock. One of them is what I call low debt, revenue growing very, very fast, and a solid market cap. And the other is the stock price is rising slower than the revenue. That is it. Those are the only two filters. And when a stock matches one of those two filters, and right before earnings, they may match this one because the stock price may not be growing as fast as revenue. Right after earnings come out, they may match the second one, and in between, they kind of go up and down. And so when I find a stock that matches it, I do a very simple rule. I buy a small tranche on the first day. If that stock goes down, I don't buy. When it comes up, I only buy if the new price is greater than the previous price. And this way, my previous trade, my first tranche, is always in the money. And if it is not, then I don't buy. So when a stock continuously keeps growing up, I keep buying it. But I buy smaller tranches every time it keeps going up. But if the stock suddenly drops, I don't buy it the next day, and I wait until it crosses my previous buy before I buy it again. It's very, very simple. Wait for the previous trade. It doesn't mean I only buy it on up days. I may buy it on down days. For example, if this stock was here and I bought it for whatever reason at this price, and the next day it only went up a tidbit, I would still buy it because my previous trade was in the money. It's that simple. If the previous trade is in the money, I buy. If the previous trade is not in the money, I don't buy. And look at this. After a month of this, Schwab has a section called risk and return. And my beta, which is my volatility, is very, very high, except my return beats even the most aggressive investment opportunity or investment strategy in Schwab. So this has become now a high risk, but also a very high return strategy. But I only do that with 4% of my portfolio. So make sure that you are using that wisely. But I'm going to continue doing what is working for me, and that is on equities. And I'll share the results when I go to my holdings. I'll tell you what has been working, which equities are performing using that simple rule. And if you need more clarification, you can watch episode 172. Episode 172 walks through it in greater detail. Let's talk about the callable muni, which I've gotten fascinated with lately. Reminder, the center of the yield curve has completely collapsed. So we still have kind of sort of an inverted yield curve. It's disinverting somewhat, but we have the middle of the yield curve completely crashing in the treasuries, and the beginning is also dropping down. But what does that do? And it has some interesting implications. The 10-year today, August 29th, was trading at 4.19, something like that. And I want to kind of say that one more time. The 10-year is at 4.19. And here is what that means. If you find a muni that is possibly trading anywhere near 4%, it could even be trading 10 points below 4%. If the pre-tax yield for the muni is kind of sort of within 10% of the treasury, then almost for everybody, no matter what your effective tax rate is, you should rather buy munis. Now, do your own homework. For me, if I adjust my effective tax rate and say my muni rate of 4%, for my effective tax rate, for argument's sake, let's pretend it's 10%. I'm just using a simple example. So then my muni is really like 4 divided by 0.9, which is 4 divided by 1 minus 0.1. That's really how I would look at it, because I would have had to have had 4.4% in taxable income, where I paid 10% taxes, and now it is 3.96 or 4% or something like that. So if you played Yield Super Bowl, that's the crux of Yield Super Bowl, what you will see is that the pre-tax yield of the muni is now higher than the 10-year treasury, which is kind of stupid. And I say it's stupid because you can earn more money tax-free than you can in the treasury. And so I figured I'd go to one of these municipalities and attend a board meeting. If I was in the board of a township, I would kind of pull that curve on the screen and I would say, well, folks, here is what we are saying. We're going to tax our own residents. Either it could be a general obligation bond, it could be a revenue bond, a toll, or sewer fees. It doesn't even matter. We're going to add levies on our own residents for the next 10 years so we can give tax-free money to people in other states that own our bonds. Who says aye to this bold motion? Can you imagine saying that? So in every town, if there was a board meeting, they would compare the 10-year yield for the treasury, 4.2%, with their 10-year muni, which for many of the townships is around 4%, and say, why are we paying 4% for the 10-year when you could get that from a treasury? We give tax exemptions, so we should really trade at something less than 4%. A rational town board president would say that. Here is what I think, in my opinion, is going to happen. Many of the muni boards are indeed going to do that. When the 10-year crashes like this, and the muni 10-year is trading at 4%, they would say, we're going to call those munis, we're going to reissue them at a lower interest rate. Now, there is a rule around that. You cannot call a muni just for the purpose of reissuing it at a lower rate, except there are munis that have callable dates. If the callable dates come up, that's the callable muni, indeed, I would imagine a municipality calls it. So let's say you bought a muni at $99 because you're the smart yield nerd. You only buy things below par. You don't buy anything above par. And it pays a 4% coupon, which is federal income tax free. And it gets called in a month or 2 months. Your money would have gone up by 6% because you made that extra $1 in a month or 2 months. And so if you extrapolate it on an annual basis, if you made it in a couple of months, it would say, oh, you're so smart. If you make 1% in 2 months, you're more like making 6% in a year. You are a genius. Except the 4% coupon is tax exempt. What a deal. If somebody gave you a CD today, which paid you 6%, you would eat it up with two hands. That is what that muni looks like. What if there is an OID? If that same muni was issued at 98, let's say it was issued 10 years ago and it was a 20-year muni, you are coming up on the call date right in the middle of the duration at the 10th year, and the muni board meeting says, wait a minute, we don't need to keep paying 4% for 20 years. We're just going to call this and reissue it at 3% or 3.5%, and people will be happy because the Treasury 10-year only trades at 4%. If somebody were to do that, then magic happens. That OID of $2 from 98 to 100, half of it was accreted to the previous owner of the muni. The other half comes to you. If you were to buy it at $99 as an example, the difference between that 99 and 100, please do your own checking. This is my research. The difference between 99 and 100, which is the remainder of the unaccreted OID, is tax exempt. So in this scenario, you get the coupon tax exempt, you get the OID tax exempt, and you get a yield call of 6%. What a deal. So here is the crazy result. So in two scenarios now, you've gotten 6%. In one case, 4% tax exempt. In another case, 5% tax exempt. What if I told you there is a world in which that bond could get called at $103? You'd be like, wait, no, how would that bond get called at 103? Well, let's dig deeper. And this is called a tender offer. And if you say, what the hell is a tender offer? It only happens for bonds issued at a premium. So let's say the prevailing interest rates are 3%. And this issuer said, we're going to give 5% because we're just that kind of people. We're nice people. Except we're not going to issue it at $100. We're going to issue it at $106 because, it's a premium. Look, we're paying so much more than the prevailing interest rate. You, bond buyer, you will pay a premium. That's the argument that's made. And now, if that bond, if you were smart enough to buy that bond below 100 and it gets called, then the tender offer works in the following way. You still get your coupon, 5% federal income tax free, plus, let's say you bought it at 98, I'm using simple numbers, and the tender offer calls it back for 103, you get another 5% gain. And if you only held it for 2 months and you make 5% in 2 months, yield to call, which is a funny calculation, you would say you made 30% annualized, which is bonkers. And you say, do these things ever happen? Is there a tender offer? Ta-da! Note the date. This was last week. Massachusetts School Building Authority was a premium bond. That bond is being called for 103. So very sweet deal. And when I started understanding how do I get more and more of these tender offers, I'm liking this deal. I started reading this paper. I'll put the link in the video. It's by the Brookings Institute. And it goes into tender offers and refunding transactions, which is where the prevailing interest rate versus the coupon of the muni bond makes the muni bonds board, makes the township's board say, we're wasting our money, we're going to be smarter. And so in this scenario, the township says, we're going to call the bond. And the argument of these authors is that sometimes it makes sense for the town. Most of the time, it does not make sense for the town. It only makes sense for the buyer of the bond. Ding, ding, ding. That's what I want to be. And so the crux of that article, which is a wonderful article, says saving 10 cents and reaching that savings by spending another 15 cents is stupidity. And professional debt managers should never say we're going to save on interest payments, which is what they would argue. Hey, the prevailing interest rates are lower. We gave a really high coupon. We're going to call that bond either on a tender offer or a refunding offer. and we're going to pay a lower coupon. That makes sense if a lot of other conditions are true, and many times that is not true. And the authors do a study which was shocking to me. When a bond pays 5% federal income tax free, the odds are 100% that at the end of 10 years at the latest, the town will call those bonds and send a nice memorandum to their residents saying, look at how good we are as town managers. As a matter of fact, we have now decreased our payments for the remaining 10 years. We are awesome. And you guys should re-elect us because we are really good. And they said they cannot find a 5% bond that is more than 10 years old and has reached the callable window. That's really what it is. You can find 5% bonds that are recently issued that still have 20 years in their duration, or 17 or 15. But if you look for a 5% bond that has 10 years left in the duration and is callable, ding, 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 that is what Brookings is saying. And so I said, really? Tell me how this could happen. And so the town says, look, we issued the bond at the premium when interest rates were 3%, and 10 years later, interest rates are at 4%. And so, why pay a 5% coupon if the prevailing interest rate is 4%? Let us tender this bond back, reissue it, and instead of the 5% coupon, we'll pay the 4% coupon. Makes all the sense in the world. Except by the time you equate a bunch of other calculations that I don't want to go into, you should read that paper. It makes no sense at all. And so, me being me, I set up queries to find bonds that fit that exact category. 5% bonds with 10 and a half years or 11 years left, with the expectation that when it crosses the twilight zone, they will get called. And I set up this filter. It's muni bonds with 10 to 11 years left. It does need to trade below par because I don't like to buy above par. And it needs to have good credit because in the event that it doesn't get called, I don't want to be left holding the bag for a muni that goes bankrupt. And it also has to pay above the 10-year treasury. And it should be exempt from AMT. Well, here is the 5% filter, which aligns with the Brookings Institution. The callable date should come up. In Schwab, there is no way to put a filter that says also make sure that the callable date is in the next 30 days or 90 days. So I have to eyeball it. But you can say, give me a muni bond with 20 years in the duration. It trades below par, pays 5%, exempt from AMT, and there is an option to call. When you do that, and I'm going to show you my holdings, when you do that, it rains muni bonds in that twilight zone. And if you think harder, you can pick those bonds up. I had 4 of my muni bonds get called exactly when the callable date was reached. And I can go back and reinvest in more muni bonds where the callable date is a month out, 3 months out, 6 months out, and play this game all day long. Here is the result. I have 99 muni bonds now. I will post a link to the list of muni bonds that I have. You can see that I always buy them below par. I'm not going to buy them above par. All of them trade above par. Thank you. And if they get called, I get to make the difference right here between 98 and 100. If it is an OID bond, I get to make that tax exempt. If it is not an OID bond, that is a gain. I still get to make their coupon federal tax exempt. So there are so many ways, and look at that, Denton, Texas getting called, and there are many more of these. Now let me go to equities. I explained the strategy. Let me show you the results. I have a whole bunch above 15% all the way up to 95% gains. I have a whole bunch between 15 and 10, more between 9 and 6, more between 5 and 3. And so this strategy of only buying when the previous trade is up has also worked out for me. It doesn't mean it's flawless. I do have some dogs, and I will be getting rid of the dogs, but I want to make sure you make your own decisions. Thank you for listening to Yield Nerd, and have a wonderful day.